Welcome back to Portfolio, everyone. And in this video, we're going over 7 stocks you should keep your eye on this week. All these companies have some big news coming out in the next upcoming week. So we're going to go over each of these 7 companies, discuss their current position, what's going to happen with them over the next few days, and discuss whether or not we're going to buy them this upcoming week. So we have a variety of earnings reports, we have new product launches, and we have some new updates and positive results coming out for each of these companies, which may make them attractive at their current price point this week. So thank you for tuning in, everyone. I am the Gen Z Investor, and as we do every Sunday, we go over stocks that you should have on your watch list for the following week. All of these companies have some major news headlines coming out, which once again may make this a nice week to jump in and buy these companies. So we're going to jump right into this first stock, which is Adobe. Currently around $471 per share, up close to 70% this year alone. So this company has been on a massive run up, and on the 52-week range, you can see here, they've actually seen a nice pullback away from that 52-week high. So over the past month, as the overall market saw some red, this company saw a pullback as well. So once again, this may be a time to jump in and buy Adobe during this upcoming week when they report their latest earnings. So earnings reports for Adobe come out this week, which once again may make this attractive. If positive earnings come out during this previous quarter, we may see a run up in share price. If we take a look at Adobe, for a growth stock, what we like to see during a quick analysis is fast growing revenue year over year. And that is exactly what Adobe has. 5 years ago, revenue around 4.8 billion, all the way up over 12 billion in the past 12 months. And you can see here a steady increase in revenue year over year. And if we take a look at the bottom line or their net income, similar trend, net income growth year over year, which is beautiful to see. So Adobe is releasing their latest earnings this week, which is why this company should be on your watch list and you should be keeping an eye on them over the next few days. Stock number 2 is another massive company, Pfizer, with a $200 billion market cap, up 9% over the past 5 years. So you can see here, not a lot of share price movement with Pfizer, but they are a dividend paying company currently yielding 4.2%. On the 52-week range, you can see they have seen a pullback, trading somewhat slightly on the high side, but nowhere near that 52-week high. So why Pfizer is an interesting company this week is for a couple different reasons. First is that they just proposed an expansion of their vaccine trial, which once again is always great news. They want to expand their trial to up to 44,000 people to see if they can get some nice positive results to one day very soon have a virus that can be mass produced and sold all across the country. So this expansion was good news for the company. And also in this upcoming week, they're having their Investor Day presentations. They're having a 2-day set of presentations where they're going to announce the future outlooks for the company, go over some research and development, and overall discuss the future of where Pfizer is heading. So if we can get some nice positive headlines from not only this vaccine trial expansion, but of course these 2 investor days, I believe Pfizer may see a nice little run up or positive investor sentiment if they have some nice positive outlook over the next upcoming years. And like I mentioned, this is a dividend paying stock, currently yielding 4.2%, 53% payout ratio, so very sustainable. And they've done a nice job of growing that dividend at a rate of 6.7% average over the past 5 years. So you're getting a nice starting yield above 4%, and that dividend is growing at a beautiful rate too, each and every year. If we take a quick look at their dividend safety rate, currently coming in at 75, so considered safe, so this company is not at risk of cutting that dividend anytime soon. So Pfizer's another one because they have some major headlines coming out this week, and I believe their investor days, they're really going to share some nice future growth potential for the company, which may make this a stock to keep your eye on over the next few days. Stock number 3 on our list is Fedex. So Fedex is on the list this week because they're coming out with their latest earnings report as well. Similar to Adobe, not a lot of earnings big news coming out, but Adobe and Fedex are the 2 big names over the next 5 days. So Fedex is currently at $232 a share, up close to 34% over the past 12 months. Nice steady growth in the company. Current market cap at around $61 billion, and this is another dividend paying stock, not a high yield, but around a 1.1% current dividend yield with a very low payout ratio of only 23.5% of earnings. And on average over the past 5 years, they've done a very nice job of growing that dividend. They have not raised their dividend in the past year, which is why their streak's at 0. They actually maintain their current payout. If we take a look at the dividend safety score, currently put in at 64, so dividend is considered safe, not very safe, not the highest dividend safety rating possible, but still considered safe at this current standpoint. So this earning report is going to be big news for FedEx. Because of the economic shutdown, people staying home and spending more time shopping online, and of course FedEx distributes and mails packages all around the world, it will be interesting to see their latest results to see if they have positively beat earnings expectations. Stock number 4 to keep your eye on this upcoming week is a massive company. It gets talked about a lot, and it's Microsoft. So of course Microsoft is always in the news. It's the second largest company on the S&P 500, and this company is a beast. Beautiful financial statements, beautiful revenue growth year over year, and this company just continues to expand. Up close to 50% over the past 12 months. Microsoft is actually at a very attractive price point right now. If we take a look, they have seen a slight pullback from where they peaked at around $232 a share. You can see here over the past few weeks, big decline down to only $204. And on the 52-week range, this company was making record new all-time highs day after day. So it's nice and very attractive at this $200 price point because you can see here no longer sticking close to that all-time high. Market cap of $1.54 trillion. This is an insanely large company, and their current dividend yield is at exactly 1% right now. So why Microsoft is attractive this week is for a couple different reasons. First is that their xCloud game streaming platform is actually getting launched this week on September 15th. It's coming out first in 22 countries and only on Android at the moment. They will later expand to iOS, but that's not available currently at their launch. So cloud gaming is kind of the next level expansion for the entire video game network, and Microsoft coming out with their brand new streaming service, which I believe is going to really expand the company into a different market that they actually aren't in right now. And of course, later this year, the new Xbox is coming out, which is another Microsoft product, which will be another expansion to the company's video game network. So if we take another look at this company, they're actually expected to raise their dividend this week as well. So Microsoft has a dividend right now of around 1%, and they've been growing it on average of at least 10% over the past 5 years. They currently pay out 51 cents per share per quarter, for a total annual dividend of $2.04, and people are expecting around a 5-cent per share increase per quarter, or the new dividend to around $2 and about 24 to 26 cents per year. So it's very interesting to see what's going to happen with this company. We have the launch of their latest streaming service. We have the launch of a potential dividend increase. And with a payout ratio of only 31%, this dividend is extremely sustainable, very safe, and Microsoft generates a ton of cash where they'll be able to maintain and grow that dividend year over year. And they have the highest dividend safety rating possible at 99. Moving on, the next stock to keep your eye on this week is another growth stock. It is Moderna. Currently just shy of $60 a share, up 272% over the past year. But if we can take a look, they've actually seen a massive decline from their 52-week high of around $94 a share. So at least a 30% decline from that all-time high, but this is still a company that's been on an insane run-up. So Moderna is a growth play. Of course, they are competing in the vaccine world, trying to get a disease and a cure out for this pandemic out as soon as possible. And why they're interesting this week is because they're hosting their virtual research and development day in this upcoming week. So if Moderna has this day and they're sharing all their latest news and innovations, what they're working on, and the potential for the latest vaccines, and of course all their clinical trials, if this company posts and shares some nice positive results and shares some nice innovation that will actually help the company grow, once again, it might boost investor confidence, and we may see a reflection in that in the share price over this week, over the next coming months. Next stock on our list is now back to a tech, but this company also pays out a dividend. We have Texas Instruments, currently around $136 a share, up 6% this year, so not a huge increase this year. 52-week range, you can see here, not directly at that all-time high. Market cap of $124 billion. This is another dividend-paying company. So another reason this company is interesting this week is because they're actually expected, similar to Microsoft, to raise their dividend in this upcoming week. So up 2.6% current yield, a 70% payout ratio, which is a little bit on the high side, but they've done a massive job of growing that dividend on average of 21% over the past 5 years, which is absolutely insane. And they've done it for 14 consecutive years, and they currently have a dividend safety rating of 90, which is considered very safe. So this is a company where it is extremely unlikely that they cut that dividend anytime soon. And in this upcoming week, they are expected to raise that dividend payment, which is why it is on this list. Moving on to the last stock on this list today, it is Walmart, the retailer, one of the largest companies in the retail space and in the entire world, with a market cap of $387 billion, up 17% this year. Why Walmart's making this list? It is a traditional retailer, and people are saying it's dying down. It can't compete with the big boys in the digital world, but now they can. Walmart's attractive this week because this is the week where they launch Walmart Plus. It's their new competitor to Amazon. It's going to be an online subscription fee, and it's cheaper than Amazon Prime, where people can go on, order products, get food and delivery in the same day. So this is what they're doing to try to rival Amazon. If you take a look, Walmart actually launches this thing called Walmart Plus on September 15th, so it launches this week. And this membership program is used to directly compete with Amazon Prime and will offer customers in-store benefits and as well online benefits. And it will be cheaper at around $98 a year or $13 a month, and you get a 2-week free trial. So this is the newest subscription service they have coming out. It launches this week, and I believe if this is a success, we may see the share price for Walmart only grow, and they can actually take back some of that market share that they might have lost to Amazon over the past few years. Walmart is a dividend payer, been paying a dividend for an extremely long period of time, currently yielding 1.58% with a payout ratio of only 40% of earnings, but this is a slow growth company, so they've only grown the dividend on average of 2% each and every year. And if we take a look at that dividend safety rating, coming in at 78, a safe dividend, not really at risk of getting cut anytime soon. Another company where if you buy in today and this Walmart Plus can actually grow and help the company expand, then the share price might be reflected in some beautiful long-term growth. So those are 7 different companies. They're all making headlines this week. So thank you for tuning in, everyone. We do this every single Sunday. I'm the Gen Z Investor, and I will see you in tomorrow's video.